This information is designed to provide accurate and authoritative information with regard to the subject matter covered. It is offered with the understanding that the presenters are not engaged in rendering legal, accounting, or other professional services. If legal advice or other expert advice is required, the services of a competent professional should be sought.
Well, good afternoon and welcome everyone. This is James Orr, and this is another recorded version of the presentation that Brian gave back on January 13th for the Northern Colorado Real Estate Investor Group, the NCREG Investor Club, on Financing 101. You can download Brian's original presentation at the address right there on the screen, ncreg.com/files. But right now, I'm going to take you through a slightly different version. This is more James's version of Financing 101 that we have recorded and made available to the NCREG members and clients that are interested in that. So let's get started. So just to recap, our focus for 2016 for the Northern Colorado Real Estate Investor Group, we've got a primary focus, a secondary focus, an area of light focus, and then things that we are definitely not covering this year at all. And so the primary focus for 2016 is going to be buying residential properties for investment, 1 to 4 units, single-family homes, condos, townhomes, duplexes, triplexes, and fourplex. That's 1 to 4 units, plus 5+ units, commercial residential properties like a 5plex or an 8plex or a 12plex. We'll also be focusing on Nomad. Nomad is buying a home as an owner-occupant, moving in for a year, living there for the full year, and then after you've lived there for a year, converting that property to a rental and buying your next property as an owner-occupant and repeating the process, ideally 10 times, but it's really as many times as you want. And that allows you to get owner-occupant financing, buy a property with very little down, and really leverage your investing ability instead of having to come up with $500,000 in down payments in order to acquire 10 rental properties. With the Nomad model where you're getting owner-occupant financing, you can do it with as little as about $100,000. So about 20% of what you would need if you were going to do it as a traditional real estate investor. We have whole classes on that model too. So another focus is selling with lease options. We're not talking about acquiring property using a lease option, but we're talking about when you own a property or when you're willing to buy a property specifically to offer it to someone else with a lease and an option to buy it. And there's some really compelling reasons to do so. It's actually one of the best business models we have going right now in Northern Colorado, and we're doing entire classes, a series of classes on that as well. So selling with lease options is one of our primary focuses for 2016 in the NCREG group. And then finally, as a primary focus, the real estate partnerships. Partnering with people, if you have the ability to do a down payment, or you have the ability to get a loan, or you have the ability to go out there and find deals, how to create and structure these partnerships and advantages and disadvantages and how to work them is what we're going to be covering this year in 2016. So there's going to be a lot of classes on partnerships as well. Now, none of these primary focuses has a priority over the others. For example, Nomad's not important than real estate partnerships, and buy and hold is not more important than selling with lease options. They're all about equally weighted. As far as our secondary focus, we're going to focus on wholesaling outside the MLS. I don't think you should be wholesaling inside the MLS in our market, in our current market conditions. But we're going to talk a lot about wholesaling outside the MLS and what that looks like and the process and how to do it. We're also going to talk about buying properties subject to the existing financing, or buying properties using a lease option. So this is the acquisition strategy with lease option, or buying a property subject to, where the seller deeds you the property and they leave the existing financing in place. So you are the new owner of the property, but the seller's old financing is still there. And that's called buying a property subject to the existing financing. We're going to cover some of that as part of our secondary focus. And then lastly, on our secondary focus is buy, fix up, refinance, and hold. Kind of the model of buying a property that needs work, fixing it up, doing a refinance to pull out some or all of your down payment, and then holding that property long term as a rental. And then our light focus area, we're going to cover fix and flip a little bit. In our marketplace, there's not that many of them. They're harder to find. The margins are smaller. And so we are going to cover that very little, but it is a very light focus. And then the things we're not covering at all in 2016, wholesaling inside the MLS. where you're trying to wholesale a property to someone else, not actually closing on it yourself. Selling properties with a real estate agent, we're not covering that at all. And then non-residential real estate investing, like buying industrial buildings or retail buildings or renting out retail space, things like that, we're not covering at all. So that's our focus for 2016. So on each one of our presentations, we're trying to put a slide in there about why investing in real estate, also a slide about overcoming fear. And so this is our slide tonight for why investing in real estate. And this is Brian's slide. So Brian talks about, how much do you need to retire and why real estate is such a great investment compared to traditional ways of saving for retirement. So he talks about, how much do you need to retire, and talking to your financial planner that, whatever your financial planner tells you, basically it's a big pile of money that you need in order to retire. Some general rules of thumb: 8 to 9 times your salary. So if you're making $100,000 a year, you might need $800,000 to $900,000 in a big pile in order to be able to retire and live off that. Another rule of thumb is about $1 million per person. So if you and your wife are going to retire, or you and your husband are going to retire, basically you need $2 million in order to be able to retire comfortably. The 4% rule. I think the 4% rule, if I'm not mistaken, it is the amount of money that you can earn 4% on and have that be enough for you to live on for retirement. So if my math is correct, if you need to build $100,000 a year, you would need to have, what is that? That's going to be like 25 times that, so $2.5 million to be able to live on the 4% rule. My math is not good enough to do 2.85% rule in my head, but you can go figure out what that is. There's a book Tony Robbins put out last year or the year before. I think it was last year. I think it's called Money, or Mastering Money, or something like that. Worth reading. And there's a recent article apparently that Brian found that talks about you need 20 times your yearly income, and then assume that you can earn 5% on that in order to live comfortably. So it's really close to the 4% rule. Between 4%, 5%, 2.85, $1 million to $800,000 to $900,000. You can use all those as rules of thumb in order to figure out how much you need to retire. But with real estate, you can largely stop guessing. You don't have to worry about how big that pile of money needs to be. You can figure out how much cash flow you're getting from your rental property and kind of plan accordingly. The rental property rents tend to go with inflation. So if you're making $3,000 or $4,000 or $5,000 or $10,000 a month right now in positive cash flow on your rental properties, and you think that the value of the dollar is going down, we're going to see inflation. Realize that will be inflation adjusted as you move forward. The rents tend to increase with that rate. Plus, you're going to have built up equity in your property as well over time. You don't need to worry about outliving your money because you're not dipping into your principal when you're just cashing rental checks. So you can kind of figure that out there. And so you just invest enough until you have enough cash flow. And then the wealth building component of it, the appreciation, the debt pay down, some of the tax benefits, they're just bonus. And so Brian likes to talk about this when he talks about why real estate versus the stocks or your financial planner model. I personally believe you should do a little bit of both, but this is not my presentation. This slide is Brian, so he's very pro real estate, and I'm pro real estate too. I just think that you should diversify just the tiniest bit. All right, overcoming fear. So Brian and I are going to be doing an overcoming fear slide on each one of our presentations. This particular slide talks about your fear of buying your first rental or getting your first tenant or your first tenant being terrible. And so how do you overcome that? One of the ways to overcome fear is to use your team. If you've got a real estate professional, real estate agent, that's great, or a property manager, that's great, or an insurance agent, that's great. Rely on your team for their expertise to mitigate your risk and to help you overcome that fear. Practice over and over again. If you're scared about talking to a tenant for the first time and doing tenant screening, come to our tenant screening class where we're going to practice that, or do some role playing with another investor partner of yours, or one of your team members that's willing to do it with you, and just role play and practice it. The way that you get better is to practice. You don't go up to a piano recital and decide you're just going to play from day one without practice. You need to practice that over and over and over again until you feel comfortable. And then when you're prepared, it's not that you're not going to feel nervous. You might still feel a little fear, but at least you'll be able to overcome it because you'll have practice and you'll know that you have some confidence because you've done that. So that's one of the things that Brian likes to talk about when he talks about overcoming fear. And consider your worst case. What's the worst thing that could happen? And then evaluate how you can mitigate those risks. And then try not to make the worst thing happen. Come up with plans to avoid the worst case and look for ways to make it better. And focus on how you feel if you don't do it and someone does. So one of the things to do is, if you're motivating yourself to move forward, there's the reward part of fear, and then there's the, the regret part of fear. So if you're saying, if I don't go and do this, what am I missing out on? So you have both the pain and pleasure of moving forward and doing stuff. You'll get the pleasure of having succeeded and doing all this, and if you don't do it, you'll have the pain of feeling like a failure and having to face your friends who you told where you were going to invest in real estate and all those other things. And so use that to leverage yourself to overcome fear and move forward. All right, the ideal model for investing, why you should use leverage. Since this is about financing, financing is really a tool of leverage. Your ability to buy a large asset, a $250,000 or $300,000 house with a very small amount of money relative to the purchase price. You get to control a $300,000 house with as much as $15,000 down if you're doing Nomad and you're putting 5% down. So that's leverage. If the property value goes up, you get a really high return on that small amount you invested. If the property value goes down, you can lose the majority of what you put in there, but you still own the asset and you can kind of wait it out and see how it goes. So let's talk about ideal. If you've never heard this before, ideal is an acronym that describes the benefits of owning investment real estate. And the I in ideal stands for income or cash flow. The D in ideal stands for depreciation or the tax benefits you get from investing in real estate. The E stands for equity buildup, the tendency for your tenant to pay down on your loan and for you to build up equity that way. The A stands for appreciation or the tendency for property values to go up over time. And then L stands for leverage. And Brian likes to point out that without leverage, it's just a great idea. Kind of doing a word play, removing the L at the end. Basically, you've got a great idea for investing in real estate, but unless you finance it and you use leverage, it's just a great idea. So he's kind of being a little bit funny there. So let's take a look at what this might look like. Here are some assumptions on your return on investment without leverage. And so this is a little visual aid I use to show you the 4 areas that we typically get a return from in real estate. And then in the center tells you your overall return on investment or ROI. So the appreciation number here, if you buy a $200,000 house with $200,000 down, you put 100% down. You buy the house completely for cash, no leverage involved at all. Well, if you buy a $200,000 house with $200,000 down, your full net operating income is your cash flow. After you subtract out your maintenance and your management, your taxes and your insurance, there's no loan left to pay on, so your full net operating income, that's basically your operating income after all your expenses, is your cash flow. And so the cash flow on that is about 1.2%. If we assume a 3% appreciation rate, $200,000 property goes up 3% in a year, it goes up $6K. Well, since you put the full $200,000 down, your appreciation rate is your appreciation rate return. So there's no leverage to that, which you'll see on the next slide here. A 3% appreciation rate means you're getting a 3% return. And there is no return from debt paydown because you don't have a loan. So you're not getting a return from paying off your debt because there's no loan to pay off. And then your tax benefits, of course, are 3%. Now, leveraging with 20% down increases returns by a factor of 5. So this is what it looks like if you use leverage. Same $200,000 house, but instead of putting $200,000 down, paying cash for the entire thing, we're saying you're going to put $40,000 down, 20%. So the cash flow, when you kind of do the math on that, is about $200 per month positive cash flow. So when you figure out your $200 per month on a $40,000 investment, your cash-on-cash return, which is the cash flow return, the green part of the return on the slide there, is about 6% per year. If you're getting a 3% appreciation rate, that means that a $200,000 property went up about $6,000 over the course of a year, and that $6,000 on a $40,000 investment works out to be about a 15% return. Now, compare that to when you bought the property with all cash. A 3% appreciation rate meant you got a 3% return. Now, all of a sudden, you're getting a 15% return because you're leveraged 5-to-1. You put down 1/5 of the property value. And then leveraging with 20% down increases returns by a factor of 5. We just kind of mentioned that. So the overall return on investment, you get a return from debt pay down of about 5.5, 15% from appreciation, 6% from cash flow, and about 14.55 from tax benefits, because that's also leveraged as well. Your overall return on investment when you put 20% down in this particular example is 41%. My personal rule of thumb when you're looking to invest here in northern Colorado, Fort Collins, Loveland area, if you can get a 30% return on investment with 20% down, I think you're doing pretty good. I think your cash flow number cutoff used to be about 5%. It's actually being pressured down a little bit. So, if you're able to get 5%, that's great. But if it's a little bit less than that, I think that that's still an okay investment, especially since the predictions for earlier this year, this is in January of 2016 that I'm recording this, the predictions for earlier this year are that real estate values will double over the next 10 years. So in a lot of cases, investors are willing to accept a slightly smaller cash flow, especially when you're getting some cash flow from the tax benefits too. I've talked about that in another presentation. But if you're getting a smaller amount from cash flow, your appreciation numbers, if you use 3%, you're getting about a 15% return from there. Your debt paydown numbers are going to be about 5.5, and your tax benefits are going to be about 14. So I'm thinking if you can get 30%, an overall return on investment, I think you're doing pretty good here in our local marketplace. So let's take a look if you do this with Nomad. Remember, Nomad is where you get owner-occupant financing, which usually has less down payment, and you live there for a full year, and then at the end of that year, you convert it to a rental property, and you move on. So basically, let's take a look at what Nomad looks like. On a $200,000 house, if you put 5% down, that's about $10,000. So I'm going to assume you have about break-even or slightly positive cash flow, not counting tax benefits. And the reason I do that is you didn't put enough down to get positive cash flow. If you had put a full $40,000 down, you would have had cash flow in this case. But instead of doing that, that $200 a month cash flow is probably now going to cover financing your down payment. Think about it. If you basically had put an extra $30,000 down, you'd have about $200 a month cash flow. In this case, you're only going to put $10,000 down, and that $200 a month goes away. You're really financing that $30,000 difference at a rate of about $200 a month, or about $2,400 a year. Interesting point about that. You'll see better than this, but if you thought about that $200 a month or $2,400 a year, how long would it take you to repay that $30,000 down payment? Assuming you have no interest on it. Well, it'd take about 12 years or so. So really, you're able to finance that down payment over 12 years by, instead of taking that $200 a month, you just say, okay, now I'm going to start paying my down payment over the time. I'm going to have the property pay for the majority of my down payment. That's the way to look at break even or slightly negative cash flow. And of course, with tax benefits, which I've shown in another presentation, you'll have slightly positive cash flow. So we assume break even or slightly positive cash flow. We're not counting tax benefits, and we're assuming a 3% appreciation rate. Well, in this case, since you put so little down, $10,000, your appreciation rate return is 60%. And this is how you figure it out. You basically earned $6,000, 3% of $200,000, $6,000 on a $10,000 investment. So your investment increased from $10,000 to $16,000 just from appreciation that first year. That's 60% return. Cash flow, we said it's 0. Debt pay down, when you put about 5% down, you're getting approximately 10% return on your $10,000 per year from paying down the debt. Tax benefits, you're going to get about a 58% benefit from taxes. Your after-tax value, that's going to be a lot lower. It's at whatever your tax rate is, but that's the benefit you get to use to offset income. Okay, so your overall return when you do the Nomad model is 128%. So we went from I forget what the first number was. It was like a 6% or something return on the return on investments, and then you had 41%, I think, was the one with 20% down, and then the return on investment for the Nomad is 128%. That's pretty significant. All right, so let's get into the meat of the presentation. I want to show you where we are in this process. So I made kind of a flow chart. When I talk about working with real estate agents to buy properties, this is the process. You go from your first meeting with your real estate agent, you kind of have the pre-showing stuff, the things you need to get done between the first meeting and the time you actually go and look at properties. Then you've got information about showings. So that, when you're out there looking at properties, then you've got the writing the offer stage. And then once you get an offer accepted, you go and contract to close. And then, of course, you have the closing. And then finally, all the stuff that your real estate agent does for you after the closing. Okay? So today in our presentation, I'm going to be covering all the things in blue and the thing in green. The thing in green is the one that's up next. And so visually, you can see the blue ones are covered in this presentation. The green one is the one that's going to be covered next. All right, so we're talking about the first meeting with your real estate agent. In this case, we're saying it's going to be with me. We covered a lot of these parts in other presentations. For example, definitions of working relationships, an exclusive right to buy listing contract. Tonight, we're going to be talking about financing. And then we're going to skip over receive property list. That's the class we're teaching this Wednesday. and then analyzing deals, which we taught last week and we'll teach several other times. Look at deals and preliminary due diligence, then writing an offer, which we'll cover later in this presentation, at least part of it. Then contract to close, verify assumptions, and complete due diligence. And then your closing, and then the continued relationship and support. So these are the things we're going to cover typically during the first meeting. And we're not going to go into all the details. It's not like I'm going to teach you a 4-hour class for each one of these in our first meeting. I'm going to give you an overview of kind of what's going on with each step. Okay. So first of all, let's cover financing, which is the primary part of this presentation of Financing 101. Types of financing. Now, before I get into the types of financing, I've got some very specific information here, which is really important to you if it's recent to when I've actually recorded this. However, loan programs change all the time. And so if you're listening to this 3 months from now, a year from now, 2 years from now, and you're like, what's he talking about? You can't go get an FHA loan for 3.5%. It's 5% now, or it's 10% now, or it's 1% now. Those loan programs may change over time. And so check with your lender if you've got questions, but we're trying to give you some good framework, some good baseline knowledge for the types of financing and what they're typically used for and how to use them. And then, of course, you go to your lender and you can get most up-to-date information from them. All right, so let's talk about types of financing. And specifically on this slide, we're talking about the 2 nothing down programs that still work in today's market. Number 1 is a VA loan. Number 2 is a USDA or Department of Agriculture loan. Okay, so for a VA loan is primarily for people with veterans benefits. You have to have VA benefits in order to get them. It is a 100% plus financing available, which you can use additional purchase price beyond the closing cost for seller concessions. We'll talk about that in a little bit. It is a fixed rate, no PMI loan. You must own or occupy the property. You cannot use it to buy investment property, but you can buy a duplex or a triplex or a fourplex and live in one of the units. In fact, that's one of the things we recommend for Nomad. You can do multiple loans if possible to use up more than, you can use up the total of your VA benefits. So if you buy a $100,000 property, you can go back and use the rest of your VA benefit for a second property or third. So ask your lender for details on how that works, but it is possible to do more than one VA loan. It's often longer and stricter appraisal process in order to do a VA loan. So just prepare for that. It's one of the reasons why some sellers don't like VA loans. And so they're a little bit harder to get accepted. But, in a slightly softer market or a property that's, been on the market for a little while, or a very sympathetic seller who, really appreciates the service you did for our country, they may be more inclined to accept a VA loan if it's, made with another offer or made with, competing against another conventional offer. So just realize that they're a little bit harder to get accepted, but you definitely can find people to do it. And then finally, you can have up to 4% seller concessions when you do a VA loan. And that could cover part of or all of your closing costs depending on how much it costs you. Okay? That's a VA loan. The other nothing down loan program, 100% financing, is the USDA loan. These are primarily rural properties outside of city limits. It's 100% financing available. It is a fixed rate loan with PMI, which is private mortgage insurance. You must own or occupy the property. There are income restrictions on it. For finding out if a property qualifies, you can try to look on the MLS and see if people say that the property is USDA approved. But I will tell you, there's a lot of agents out there that do not enter these correctly, and so do not rely on that a property says it is USDA qualified. You need to go use the USDA mapping tool to verify if the property qualifies. Many agents don't correctly identify that. I just told you about that, so definitely check it. And on a USDA loan, you can get up to 6% seller concession. So that can cover the overwhelming majority, if not all, of your closing costs if you decide to ask for seller concessions. And of course, the offer structuring part of this is a different discussion. The fact that they can do 4% doesn't mean that we can get an offer accepted with 4% seller concessions. And so we'll have to talk about that another time. So those are the 2 nothing down loan programs. All right, let's talk about another loan program called FHA. It's by the Federal Housing Administration. And this one's not nothing down, but we can use some down payment assistance programs in addition to the FHA loan in order to get it down below 3.5%. And we'll talk about that a little bit later, I think. So it's 3.5% down for the down payment. It's a fixed rate loan and it has PMI. The PMI on the FHA loan, it's a little bit gnarly, honestly. At one point, you used to be able to pay it in until your property got down below, I think it was 75% of value, until your loan to value was about 75% of the value of the property. And I think they've changed that. I think it must have been a couple years ago now. But now the PMI does not ever go away. And so if you have an FHA loan, you'll have PMI for the full 30 years of the loan. However, you can get an FHA loan when your loan gets down below, 20% equity or 80% loan to value or 75% loan to value, whatever number your lender wants you to have. You can refinance out of the FHA loan and get rid of your PMI and significantly improve your monthly payment unless interest rates go way up. So just kind of realize that. I don't know if Brian actually talks about this, but one of the interesting things about FHA is they're assumable. And so the loan itself may become valuable later on if interest rates go up to 6 or 7 or 8 or 9 or 10%, and you've got a 4% FHA loan, the loan itself may become an asset because they are assumable type loans. So it's an interesting thing to kind of keep in mind as we move forward with FHA in the future. All right, getting back to the presentation, though, the actual slides. So it's a fixed rate with PMI, private mortgage insurance, and that can't be canceled. You have to refinance out in order to get rid of it. It can be as low as, I actually have heard 580. Brian has that on here too. 640 credit scores is what they really want. You can do it if you've had a bankruptcy, but you have to wait at least 2 years after your bankruptcy. And then you could do it if you've had a foreclosure, but there's a 3-year wait after foreclosures. Short sales, I think, are also 3 years. But you could double check with your lender on that. So bankruptcy, 2-year wait, foreclosure, 3-year, and short sales are 3 years as well, I think. But double check with your lender. You must own or occupy the property, so you have to live in it, but you can do duplexes, triplexes, and fourplexes. So you can actually buy a fourplex with 3.5% down FHA financing if you move into one of the units and if it falls within the FHA loan limits for your county. And there are county-based loan limits. I think Larimer County right now is $340,000 loan limit. So if you can find a duplex or a triplex or a fourplex in Larimer County, you can actually buy it with FHA, 3.5% down, as long as your loan doesn't exceed $340,000. Brian mentions here there are max loan limits by county. I think Larimer is $340,000 right now, $340,000. And you typically can only have one FHA loan at a time. Now, there are some exceptions to that. For example, if you move more than 100 miles away and you had an FHA loan in a previous property and you've kept that loan, I think there's an exception. You can get another one. If you inherit a property and it's your parents had an FHA loan and you happen to inherit that and you already had an FHA loan, I think you can have an additional one there. But the exceptions are relatively rare, and I would talk to the lender to see what the exceptions are if you think you might fall into those. Brian also talks about FHA 203K loan program, which is the ability for you to roll repair costs into an FHA loan. So for example, you go out there, you find a perfect property, except the property has a kind of dated kitchen. And you're like, everything else about this property I love. I love the location. I love the living room. I love the layout. It's got the right bedrooms. It's, right where I need it to be. And the only thing you don't like about it is the kitchen's from 1960. Well, you can go get an FHA 203K loan program and purchase the property and enough money to do the repairs to update the kitchen. So let's say the house is $250,000, but you're going to need $20,000 in order to do the kitchen. You can actually get a loan where you put 3.5% down of $270,000. And you get a special loan program. It's called the FHA 203K. And then you can actually use the $20,000 in order to do your kitchen. And then you'll have the loan for that full amount. So it's actually a pretty interesting loan program. Makes a lot of properties that you're like, I like this, but I don't like this. Well, then we say, well, what if you could get those repairs done? And we talk about that. As I mentioned before, down payment assistance available. So we use those with FHA a lot of times, and like the county may offer a program where they will contribute 2.5% of your down payment. So you really only need to come to the table with 1%. Check with your lender to find out what the current local county programs are. I personally don't keep track of them. I allow lenders to kind of become an expert and remember all those loan programs. I do know a little bit about them. I know that they exist, and then we call the lender to find them. And then finally in here it says 6% maximum seller concessions when using an FHA loan. All right, let's talk about conventional financing. Conventional Fannie Mae, Freddie Mac type loans, they're typically fixed interest rate loans and 30-year amortization. So, Brian has in here, why not do 15? In my personal opinion, if you're going to go buy a property, especially as an investment, you should probably pick the 30-year loan program. If you want to pay it off on a 15-year schedule, you're welcome to do so, and you can pay ahead on it. May not be the best thing to do, but you're welcome to do it. Why not just get a 15 if you plan on doing a 15? Well, one of the reasons is, what happens if cash flow becomes tight later and you need that extra money for medical bills or repairing a car, or or another reason is actually they would need to use the 15-year repayment schedule to qualify you for your next property. You need to be able to support that. If you had a 30-year loan and you were making payments on a 15 and you were trying to buy another property, they would use the minimum payment, the 30-year loan payment, in order to see if you qualify for the next property. So for loan qualification reasons, you probably should not do a 15-year loan. For types of financing for conventional, typically it's higher credit scores, 740 plus for the best interest rates, so maybe able to go a little bit lower for that. For owner occupants, it could be as little as 3% to 5% down. You'll have private mortgage insurance if you put less than 20% down. But you can buy these with as little as 3% down with current loan programs. For Nomad, we usually recommend 5, although you could get them with 3. Your payment's going to be a bit higher. And you can get these types of loans until you have 10 financed 1 to 4 unit properties. So for the first 4, you're typically going to put 20% down. And then for loans 5 through 10, you'll typically put 25% down. Now, if you're buying a duplex or a triplex or a fourplex, you want to add 5% to those down payments. So if you got a duplex as your second property, normally we'd put 20% down for a single family home, but because it's a duplex, you'd put 25. If you bought a duplex for your sixth property, if it was a single family home, we would have put 25% down, but because it's a duplex for number 6, we add 5%, so it would be 30% down. So you can kind of get a feel for how much down payment you need for each one of those. Once you start to see these down payments, you start to understand why Nomad becomes really attractive. Because now all of a sudden you only need to do 5% down instead of having to do 20% down for these investment properties. Okay. For Fannie, you can do cash out refinances up to 4 properties, up to 4 1 to 4 units. For Freddie, it's up to 6. So you can go up to 6 and do cash out refinance. With both of them, you can do rate and term refinances up to 10 1 to 4 unit properties. Now, what's a rate and term refinance? A cash out refinance is when you actually refinance a property and the amount you're borrowing is more than the previous amount you had borrowed against the property. So let's say you owed $100,000 on a $200,000 property. You could go and do a cash out refinance and maybe you borrow $120,000 on that property. You pay off the $100,000 underlying loan and you actually get $20,000 cash out when you do your refinance. That's what a cash out refinance is. When you do a rate and term refinance, basically you owed $100,000 on a $200,000 property and you are refinancing the loan to change the rate and or the term of the loan, and you're not pulling cash out. So it'd still owe $100,000, but maybe your interest rate went up or down. And maybe the term, maybe you had 28 years left on it, and now you're refinancing, and now you have 30 years again on it. And that's what rate and term refinances are. And then for conventional, the seller concessions vary depending on whether you're buying owner-occupant, whether you're getting investment properties. And so it's 2 to 9% is the range. It's 2% for non-owner-occupant. So if you're getting an investment property on conventional, it's 2% maximum seller concessions. If you're doing 20% down as an owner-occupant, you can get up to 6% in seller concessions. If you're putting less down, the number goes down. Okay? And that's conventional. Let's talk about portfolio lenders. Portfolio lenders, when you run out of conventional loan spots, a lot of times will go to a portfolio lender. For example, a portfolio lender in town is First Bank. Typically, they're keeping the loans in-house in their own investment portfolio. They're not selling them on the secondary market as conventional financing. So typically, they're going to be, most of the time, they're going to be ARMs, adjustable rate mortgages. So usually it's either a 3-year, a 5-year, or a 7-year ARM. And what that means is, in this case, it's talking about a 30-year loan. So the loan is as a 30-year term. You'd pay it off in year 30. Has a 30-year amortization schedule. It means that it totally pays itself off over the course of 30 years. But for 3 years, the first 3 years of it, the interest rate is fixed at whatever you guys agree to, you and the bank. And then after that, for 27 years from then on, the interest rate is variable. It adjusts. Now, they do have caps on it, so it can't go above a certain amount. Sometimes they'll even have caps so they can't go below a certain amount. So it'll be within a range, but the interest rate can vary during that's kind of 27 and a half years after the first 3-year lock period. So a 3-year ARM, the interest rate is locked for the first 3 years. For a 5-year ARM, the interest rate is locked for the first 5, and a 7-year ARM, the interest rate is locked for the first 7. After that, the loans are variable, and they can adjust up or down from there. So while there is an interest rate risk, because after that 3, 5, or 7 year period where it's fixed, it can vary, there's no balloon risk. And by balloon risk, when you go and you talk about commercial loans, a lot of times they're on a balloon where you could have a 30-year amortization. The payment's based on if you were paying it off over 30 years, but the loan is only for 10. That's called a balloon. So basically the loan is good for 10 years, and at the end of the 10-year period, you would have to pay off whatever you owe, the balance, at that time. And we call those loans with balloons. Portfolio lenders, at least First Bank, doesn't usually do balloons on the residential side. If you're going to go get a commercial loan, they usually do have balloons. Okay, so most of the time we're talking about portfolio loans. You want to avoid balloons, in my opinion. The joke is balloons are for clowns. They are not for investors. Okay, so don't do balloons. With portfolio lenders, there's no hard limit on the number of loans. You still need to be able to qualify for them. Usually it's pretty fast underwriting. Some are 24 hours. It still depends largely on the debt service coverage ratio, which Brian teaches about in his deal analysis class on his spreadsheet. Teaches you what that is, how to calculate it, and it actually calculates it for you when you do the spreadsheet for him. But the lenders like to look at that number to make sure that the debt service coverage ratio for the property you're buying and for you is actually in line with what their underwriting requirements are. Bigger purchases you make typically goes to a loan committee, and so they get a bunch of people together who kind of look at it and evaluate the risks to the bank, and they decide whether or not they're going to make that loan. And then the relationship with the bank matters. So if you have $100,000 on deposit there, and you're coming in there and looking to get a $300,000 loan, that's going to make a bigger difference than someone who does not have an account there, or someone who has $50 in their account there. So just realize that that has an impact on whether or not you'll get a loan from a portfolio lender. Let's talk about commercial loans. Typically, commercial loans are going to be for 5 or more units. Some banks may do a commercial loan for less than 5 units. Like they may do a triplex or a fourplex and do that. But most of the time, we're going to see this with 5 or more units. It doesn't count. Commercial loans don't count against the 10 finance properties you have for conventional, which is important if you're doing your loan planning, which we're going to talk about. The nice thing about commercial loans is an LLC can actually be the borrower. You'll probably need to sign too and be personally liable for the loan, or at least someone will be if you're going to structure a partnership, but the LLC itself can be the primary borrower on there. The loan programs for commercial, they vary widely, and they're constantly changing. So if you're interested in those, you're definitely going to want to talk to your lender, talk to some different commercial lenders in town, and see what kind of loan programs they can offer for you. I will also mention that relationships with these banks, especially how much you have on deposit, can help a lot. And sometimes they'll even say, if you come over, our interest rate's going to be this. If you don't come over and put your deposits with us, we're not even going to give you the loan. So the underwriting depends largely on the guarantor, the person signing and saying they're responsible for the loan, and the property itself. They may have other requirements such as providing financials for the property and yourself personally or the guarantor each year to the bank. Some lenders are pretty strict about that. Some are pretty lax about that. So just realize what you're getting into when you go in there and do this. Let's talk about a couple other options for financing. We covered the major areas. So a couple other ones though. Private money. Private money is primarily going to, your great uncle or your brother or your father or your sister and saying, hey, listen, I've got this great real estate deal. You're earning 2% on your CDs in the bank. You've got $200,000 in there. Why don't I pay you 4 or 5 or 6%, and you can actually do a much better return, and I'll buy the property, I'll make some money on it, and I'll be able to pay you a much higher return than you're getting at the bank. So it is primarily people that you know already. You're not typically going to find people that are advertising, I am a private money lender. Typically those people, when they're in the business of lending money, they are hard money lenders. It's typically how it works, because the ones that are lending privately are your private friends and family. These can be more flexible than banks and can be much faster to close. So you go talk to your sister and you say, listen, can I borrow $200,000? She may say, sure. Do you want a check? And then you can get it that day. The relationship is primarily what the qualification factor is going to be. You still need a good deal, and you may still require some financial statements if you're, the people that are loaning you the money are savvy to it. But a lot of times this is based on your relationship. You're going to take care of your mother, and you're probably not going to screw her over. And so the idea is that they're willing to lend you money in order to buy properties. Typically, right now in our current interest rate environment, we're seeing 4 to 8% for private money loans. Sometimes they're a little bit lower, sometimes they're a little bit higher. Hard money loans. Typically for a fix and flip or buy fix up refinance strategy, the property is going to be very important to the lender. Most of the time these lenders are not going to have really close personal relationships with you. They may be someone you meet in an investor club or referred to you by your realtor or something like that, but they will also screen you pretty hard. I mean, it's a qualifying process. And the interest rate for these is going to be a little bit higher. And the loan to value is typically going to be a little bit more conservative, a little lower. It's not unusual for them to say, 70% of the after repaired value or 70% of even the purchase price. So realize that the hard money loans are going to be a lot higher interest rate. And for that reason, there's a lot of people that would prefer to go and get more traditional bank financing than to go do a hard money lender. But the benefit of a hard money lender is the availability of funds and the speed at which they can close. So the interest rate for hard money, typically in the 10 to 15% range, with 1 to 5 points. There was a time when it was higher than that. It was higher than 10 to 15. We've seen a dropping of interest rates over the last decade, and so interest rates have gone down for hard money as well. Another way to finance is with partnerships. If you don't have the ability to go get a loan, maybe someone else you know does. Maybe they want to invest the equity they have in their home and actually get a loan on their home at 4%. And use the cash from that refinance. They do a cash out refinance and use that to buy an investment property. And maybe they want to do it in a partnership because they're busy. And you have the time and the expertise in order to go find properties. So realize that there are other ways to finance as well. Okay, some other ways to finance. So home equity loans or a line of credit. Maybe you could take equity out of your home and use that to buy rental properties. You could use it as a buffer for when you need repair money or you need to buy a property, fix it up, resell it, and then refinance it, or buy a property, fix it up, refinance it, and then hold it. Another type of financing is owner financing, where the seller themselves acts like a bank. They own their property free and clear. They don't have a mortgage on it. You go to them and you say, listen, I'll offer you $300,000 for your property, but I want you to be the bank. I'll pay you $1,500 a month and at this interest rate for this amount of time. And they say, okay, I'm willing to accept those payments. I'm going to act like the bank, and they're going to do the same documentation that a bank has, note and deed of trust here in Colorado, and they're going to structure it such that they're acting as the bank, and they're going to finance it for you. Brian has a note in here. This typically, with owner financing, you can offer more than their house is worth if the terms are right. The idea being that if interest rates at a bank are 4.5% for an investor loan, and you go in there and you offer the seller 3% interest, you could probably offer them more than their house is worth and have it still work out to be mathematically the same. In fact, you probably could structure it in such a way that it is a little bit better for you than going to a bank and getting financing. If the seller is willing to go along with that, they maybe say, I'm willing to take a slightly lower interest rate because I'm getting a premium for my house. Of course, you can buy a property with all cash. You don't need to go get financing on it. And in some cases, you could use life insurance or Roth IRAs or other specialty type investment programs. I would talk to a professional that specializes in those because there's lots of rules and regulations about those. And then I added 203K loan program here when Brian had listed it before in another spot. So I'm going to make a note to remove that from this slide as well. All right. I'll do that when the presentation is done. All right, so let's talk about some advanced strategies. Plan your loans. So one of the things I'd like to sit down and talk to clients about early is coming up with a plan for their loans. If they tell me, listen, I'm serious about this investing, I want to do a bunch of properties, we usually talk about the first idea we talk about is usually the idea of alternating between spouses. So if the husband is going to do the first one, instead of doing the loan where they're both on it and they use up a spot on each one of their credit reports, what they could do is have the husband buy the first one and the wife buy the second one, and then the husband buy the third one, and the wife buy the fourth one. And so they can alternate back and forth. That way, instead of only having a 10 loan limit for their Fannie Freddie loans, now they have 20 between them. So they still need to qualify for all of them. That's definitely the thing they need to do. The personal residence that you have counts. And then portfolio loans, another 1 to 4 units, could count against the 10 as well. So just realize that. But if you know that you have a limit, planning this out in advance and knowing what you're doing is really important. So they're all 30-year fixed rate loans, the Fannie and Freddie loans. That's why it's so important to do this. You don't want to get stuck, going through the first 10 really quickly and then realizing that you could have gotten 20 30-year fixed rate financing loans and if you just planned a little bit more from the start. So after the 10 finance properties, you're probably going to use a portfolio or commercial or a private loan. And if there are 5+ units, you typically don't have to count those towards your 10. Your lender will tell you what they're counting and what they're not counting. I would disclose everything you own so that you're not committing loan fraud. But basically, the lender will tell you which ones count, which ones don't. So use the first 10 spots you have wisely. Some would argue that you want to get your higher mortgage amounts on those first 10 loan spots because they're lower interest rates and they're 30-year fixed. But the idea is to have a plan. And of course, Brian points out in here, if you're married, consider alternating taking loans, only one on each loan until you get to 10 each. So 20 total between the two of you. Occasionally someone in class will make a joke about, getting multiple spouses so they can get more loans. But I don't recommend that. It's probably not legal. All right, so let's talk about another advanced strategy, changing the rate. So if you go to a lender today and you say, what is my interest rate if I got a loan today? They may quote you and say, your interest rate today is 5% with 1 point, which means if you pay the lender 1% of the loan amount you're getting, you can get that rate. That's what the 1 point is. You can get 5%. Okay. If you were willing to pay the lender more, let's say, well, what if I paid you 2 points? What would the interest rate be? And the lender can go type in their computer, look it up on their screen, and say, if you pay 2 points, the rate might be 4.625 instead of 5%. And so you say, okay, so I could pay a little bit more and get a slightly lower interest rate. That's very interesting. What if I don't want to pay the point? And they can actually price it out and say, okay, if you pay no points, the interest rate is going to be 5.125. It'll be a little bit higher interest rate than if you paid 1% of the loan amount. Okay. One of those strategies that Brian likes to go through, and he does a bunch of examples of this, and I'm not going to show his examples because they're kind of an advanced strategy, but if you can come to one of the live classes, it's pretty cool. But he talks about this idea of pricing out buying down your interest rate for a large range of prices. So, everything from 1 to, 5 or 6 points, if you can get them to do that, right? So you can go and look and say, if I go pay you 5% of the loan amount, what's the lowest my interest rate can go? If I'm going to pay you 4.5 points, what's the interest rate? And you can actually go look at it. But the most interesting thing is, the question comes up, is it better for cash flow, net positive cash flow at the end of the day, to buy down your interest rate or to put more down? So let's say you're going to buy a $300,000 house, which you would need about $60,000 down if you're putting 20% down. But let's say you have $80,000. So you've got an extra $20,000. Would it be better to use that $20,000 to buy down your interest rate, or would it be better to take that $20,000 and actually finance less, use a bigger down payment, put $80,000 down instead? And the answer is it depends. You actually do need to do the math and see, because there are some cases, and it's surprising to a lot of people, in some cases it's actually better off for you to buy down the points on the loan to get better cash flow. And then you got to figure out where the break-even point is to make sure you hold the property long enough to make sure you make that money back. And Brian covers this kind of advanced topic in classes from time to time, so I would definitely check out that. And I think he had some examples on the slide deck I mentioned at the beginning of this presentation. So if you want to go see some of the examples from that part of it, go check out his version of this presentation. All right, so let's talk about financing for nomads. Nomads are a really important group for our Northern Colorado Real Estate Investor Club because we love them. We love the idea of someone, buying an investment property, putting a small amount down, getting involved in the real estate investing community, living in the house for a year, and then converting that to a rental after they've taken some classes and they understand the process and they're ready to move on. I think it's a great way to build wealth. And so we love nomads, and we want to kind of serve them and really structure some classes and help educate them on the concept. So let's talk about financing for nomads. So Nomad Loan Basics, this is the preferred order in an ideal world, and it's really hard to do in our local marketplace. Let me just kind of start by saying that. If you have the ability to do this, this would be ideal, right? If you have VA benefits, if you were a veteran like me, you were able to go out there and get VA benefits in order to get a loan, you should use your VA benefits first. And in my opinion, if you can, use your VA benefits in order to buy a duplex, a triplex, or a fourplex, the largest property possible that has good cash flow in our local marketplace. Okay? So in ideal world, you do a VA loan first for multifamily. If you can't do that, you don't have VA benefits, you go down to the next step. multifamily with FHA. So if you can get an FHA loan and get a duplex, triplex, or fourplex somewhere here in northern Colorado, wherever you're kind of doing your nomad model, if you can go and do that, that's ideal because you can get a duplex, triplex, or a fourplex with 3.5% down instead of the 25 or 30% down you need with conventional financing. Makes a huge difference. You're able to kind of acquire a very large asset with very little down. And so do multifamily with FHA if you can. Now, and a lot of times in our local area, we're not going to hit the loan limit for doing a duplex, triplex, or fourplex with an FHA. And so you just get priced out of our marketplace because of the loan limits we have. So if you can find one, great, and I've had clients do it. If you can't find one, don't stress. The Nomad model still works amazingly well, even if you don't do this loan program in this order, in case you just decide to do conventional upfront first. Okay, so then the order would be conventional. In my opinion, you should put 5% down. There are some clients that want to do 3%. There are some clients that want to do more than that. But I use the model when we talk about Nomad, 5% down conventional, and you use that for the rest of your loans. Now, you could, at some point, if you have enough equity in the ones you use with FHA, refinance the FHA one into a conventional, and then use your FHA benefit to buy another duplex or a triplex or a fourplex halfway through your cycle or whenever it is that you have enough equity. So that's definitely a strategy you can use for the loan program. Now, owner-occupant financing, to be clear, you must move into the property. And the rule is usually 12 months, set by the lender. You must move into the property. So can you say, well, can I just tell them I'm going to do owner-occupant financing, but then don't really move in? Or can I just kind of say, yeah, I'm doing this as an owner-occupant, but kind of, live with your friend and not really ever move in there? Maybe you say, well, I've got a room. I keep a room in one of the properties. I charge them less rent, and I have a room there that I call my own. No. Move into the property. The plan is good enough without you trying to game the system and commit loan fraud, which is really what you're doing. So don't try to game the system and commit loan fraud and possibly have to go to jail. And Brian tells a story about one of his tenants that actually went to jail for loan fraud. So it's a serious thing. So don't just say you're going to live there and not move in. Definitely need to move in order to do owner-occupant financing on the Nomad model. Now, if you're doing investment properties, you're putting 20% down. Tell your lender you're not moving in. Everything's fine. But if you're doing Nomad, you got to move in. You're doing owner-occupant, I got to move in type financing. That's what owner-occupant means. All right, so let's talk a little bit about using equity in properties. So here are a couple different ways to access equity you have in properties. You can do a cash out refinance. We talked about before. You owe a little bit on a property. You do a cash out refinance. You pull out more than you owed before, and you're able to use that cash somewhere else. Banks don't usually like this, especially with large amounts within a few years after purchase. You bought a property significantly undervalued. You got a loan on it 2 years later. You're able to go in there and pull a bunch of cash out of the property. Banks look at that and they raise an eyebrow. They're like, that's kind of weird. Why is he doing that? So they don't like it. So one suggestion is to get a second lien on the property and then refinance both of them into a new first. A new loan is really just a rate and term refinance in the bank. You may need to season it, and then check with the bank first before you do the second lien. I heard from a lender in the audience during the live class. They said they don't like doing that and that they probably won't do it. I thought you could do it. So I don't know. I can't think of a specific example when I've seen it done, but I thought it was possible, and I thought lenders would do it. But one lender said you were not allowed. By the way, this is actually a really great point. Just because one lender tells you it can't be done, does it mean that it cannot be done? And the answer is, of course, no. We have lenders that have very specific programs, and they cater to very specific situations and niches, and they have, custom products that they can do things that other lenders can't. And we see it all the time. You may need to go talk to 1, 2, 3, 5, 10 different lenders in order to find the specific type of loan program that you're trying to do if you're in an unusual situation. If you're just trying to do plain vanilla conventional financing, a very large number of the lenders can do those, no problem. But if you're doing something a little bit unusual, sometimes we need to go around and ask, half a dozen different lenders and see until we find one that can do it or that can offer a slightly different way to structure it where it would work as well. Okay, getting back to the slides. So you could use a HELOC, a home equity line of credit. That's what HELOC stands for, to access funds as needed. You put a HELOC across multiple properties if you wanted to. Talk to your lender if you're interested in getting a home equity line of credit set up on that thing. You can get a second lien on properties. They're typically more expensive, higher interest rate than the first, and some lenders won't even do them at all. They're like, no, I only want to be in first position. Second lien is just the loan that was put on there second. That's what a second lien is. You can also consider having a partner invest. If you need to tap equity in your properties, bring in a partner, have them cash you out for part of it, and give up part of your ownership or part of your cash flow in order to get cash out. Then you could buy another property and repeat. And then lastly, if you have equity in a property, you can consider selling the property or doing a 1031 exchange and reinvesting the proceeds. A 1031 exchange is just a fancy way to say you're selling the property, but you're not taking the cash yourself. You're setting it aside so that you're not paying taxes on it right now at this sale, and you're reinvesting it all, and you'll pay taxes later on the next sale. That's what the 1031 exchange really is. Okay, so let's move on. Preparing for financing. Okay, so let's talk about getting your financial house in order and being ready to do financing. So number one, know your credit report and score from all three credit agencies. Typically, the lenders are going to use your middle score. So if your one score is low and your one score is high and the middle score is this, they typically will want to look at your middle score. They'll ignore the high one and the low one. Okay, so when you're looking at your credit report, look for anything that is incorrect or inaccurate. If it lists that you didn't pay your cell phone 2 years ago, go try to get that fixed. Okay, resolve any negatives that may happen to show up on your credit report. So maybe you didn't realize that your credit card was stolen by somebody and they were, ringing up charges in another state, and this is the first time you looked at your credit score. Go get that fixed. Go resolve it. You may want to consult with your lender, and certain lenders are much better at this than others, by the way. There's a wide variety, but certain lenders are really good at helping you improve your credit score. They understand it. They help people in that situation all the time. Other lenders, they tend to work with people that don't have credit problems, and they're not really aware of a lot of these challenges and how to overcome that. So realize you may want to work with a lender that's good with credit challenges. We can also go work with a credit counselor, someone who's in the business of counseling people on how to improve their credit and raise their score. There are things that happen on your credit report which are not necessarily obvious. For example, had a client last year. They went under contract to buy a house. It was a very young couple. They ended up getting married while the house was under contract. And when they got married, they went down and they opened up a joint bank account. And on the joint bank account, when the banker was sitting across the desk, they asked him, "Hey, do you want overdraft protection on your new bank account? That way, if you write a check and you happen to go negative, we'll just go ahead and set up a small loan to you for that amount, and it's not going to be a big deal. You'll just have to pay it back, and let's set that up on the account." And they said, "Sure, we'll go ahead and do that." Well, by opening up this new credit line, the new basically overdraft protection on their account, they opened up a new credit line, and it actually affected their credit score, and their affected credit score actually changed the interest rate that they were able to get on their house because of just doing that one small thing. So it may not always be obvious. So we always warn people when they're about to buy a house or they're under contract to buy a house, don't do anything with your credit. Don't go buy a refrigerator, same 90 days, same as cash, we'll finance you here. Don't go buy a new car. Don't buy new furniture. Don't close down any credit cards, because that could negatively impact your credit score. If having the account open was actually helping your score, then closing it down could actually hurt your score. So be really, really careful about this, and talk to your lender if you're going to do something that might possibly affect your credit score. And I would be on the very liberal, generous side of considering what might affect your credit score. So don't go do something and say, "I didn't realize that opening up overdraft on my checking account would affect my credit score." Yeah, things like that do. Next thing is understand your debt to income ratio. The lower this is, the better. So your debt ratio compared to your income, if it's lower, it means that you have less debt that your income can handle and support. Get organized, digitize your documents. Brian makes a great point about this. If you're going to be applying for multiple loans, you should systemize this process. Save all of the things you need, and I think we're going to list out what they want here on the next slide, but save everything you need in Dropbox or some other type of organized system so that when you go apply with a lender, you just go ahead and send them that whole folder, and they got everything you need. That way you don't go have to get documents from 9 different places and say, "Do you need this? Do you need this?" You just know, this is everything I need. So we're going to give you a list here. If you're self-employed, you'll need 2 years of tax returns, and ideally showing increasing profits year over year. Don't overstate your expenses on your taxes, especially if you're a small business owner, to minimize your tax liability, because they're going to look at that. So I would not go and try to minimize these things. I would really focus on having a fair estimate, especially if you know you're going to buy a house, having a fair estimate of your income, and maybe sit down with your lender a year or two in advance and say, "Listen, I'm about to do taxes. I know I'm going to be buying a property in a year or two. What should I be putting on my taxes? Should I be taking this many write-ups, or should I just pay the taxes on some of these things?" So realize that is a big impact. Budget and save for down payment and reserves. So when's the best time to start saving for your down payments? Yesterday. When's the next best time? Today. So go ahead and just start saving for down payments and putting some money aside for reserves. And a great way to do that is to actually do a budget. I know it's the dirty B word, but you really should kind of get organized and plan for down payments and cash reserves. All right, let's talk about contacting lenders and finding a lender to work with. So there are a couple different sources for finding lenders. I recommend you do call a couple banks and a couple mortgage brokers just to get a feel of different programs they have and different qualifications to see. I recommend a bunch of different lenders that I've worked with and my clients have had good experiences with. If you go to my Northern Colorado Real Estate Advisor book, the book that I normally give to clients, it's a big 8.5 by 11 book that's got the whole process for buying, the whole process for selling, process for investing, the referral directory, and copies of all the contracts and paperwork in it. If you go and look in that, the referral directory has lenders in it. And so I'd look in there. If you don't have a copy of that book, you can always just go on jamesorr.com/referral directory, and that lists all my lenders as well on there, and you can get their contact information. Now, the reason I recommend you use the ones that I refer is because these are lenders that I've actually closed loans with clients, and I've had good experiences with. That's one of the ways you get in my book. If you use someone else, it's really like playing Russian roulette. You could go and pick a lender, and you could do great. I mean, it could be an amazing experience, and I'll add them to my book, and it was amazing and fantastic. That's how these other lenders got added. At one point, they were new to everybody. But if you go pick your own lender, there's a chance that it could be less than ideal. You could show up at closing and realize your money's not there, that they don't show, and you're not qualified. And guess whose fault that is? It reads very specifically in the contract. That is your fault as the buyer. It is not the lender's fault. They have no liability. You are responsible for that. So it's not fun. So I would definitely lean toward someone who is recommended and referred to you rather than trying someone new, but it's totally up to you. It's your decision as the buyer to do that. You may find it more difficult to go with the big banks versus local banks or brokers, especially if you have more properties and loans. You want someone who's going to go to bat for you and do that. Brian has this big point about not using the huge online sites either. I tend to agree with him. I've actually never closed a loan with like Quicken Loans or whatever those other crazy big banks that advertise on TV at late night. And there may be a reason why. They may not be able to perform. Who knows, right? But I've never closed a loan with them. All right, so calling lenders. So when you're calling lenders, one of the things you want to do is you want to ask for rates. And you want to do this on the same day. You don't want to call a lender on Monday and then call another lender on Friday and call another lender 2 weeks from then, because the interest rates do change every day. And so in an ideal world, you sit down on a Monday afternoon and you call 2 or 3 lenders and you get their rates and their fees all on the same day. That way you can compare apples to apples better than you can if you did one on 1 week and one the next week, okay? There are 2 options, in my opinion, for getting rates with your credit score. Number 1, if you don't know your score, you can have, if you know your score, tell them not to pull your credit yet. Say, I know what my score is. My middle score is going to be 740. Can you please run rates for me as if I have a 740 score? Of course, if I go with you, we're going to pull rates and do that. I just don't want to have additional credit pulls on my record because it can impact your credit score. A certain number of pulls can impact it. So if you do know your score, you don't need to worry about it. If you don't know your credit score, one of the things I recommend people do is you have the first lender you deal with, the one that you think you're going to use blind. If you're getting recommendations from me, one I tell you, this is probably going to be the best bet for you, but call these other guys too and make sure if you use the one that I think is going to be the best bet for you, have them pull your credit. And then when you call the second and third one, say, my credit score is this. Of course, if I decide to use you, I will go ahead and have you pull my credit score too. But let's not have you pull it up front. Go ahead and run rates at this credit score, 740, whatever number is. Okay? And so do that. And then when you're talking to them on the phone, I give you some questions that you might want to consider asking them. You don't have to do these questions, but if you're relatively new to the experience, reading through these questions might give you an idea of some things you may want to ask them about. Things that you may not have thought were important or that now you realize are important. So you can go look at on the next 2 slides of some examples, and I have a page on my website where you can go get access to all those questions because there's more than just on the next 2 slides. And then find someone that you can communicate with easily. You may find someone that's offering you an 1/8 of a point better interest rate, but they're really kind of harsh on the phone and you don't really get along, or they intimidate you and they're not easy to answer your questions, they make you feel stupid. I mean, who knows? Any reason that you just don't get along with them, and it may be worth paying the eighth of a point higher to deal with someone who's going to take their time and serve you well. So don't be afraid to do that. And if you've got questions, of course, you can ask me as your realtor or whoever your realtor is. I mean, ask them for help. But I would definitely find someone that I connected with. And sometimes it's not always about the cheapest thing. Okay. Brian also in here. Are they timely in responding to you? And I agree. If you send them an email in the morning and you don't hear back till the next day, that's a little long for me. I think people should get a reply within at least one day. I mean, the same day. If you email them at 5 o'clock at night, I wouldn't expect a response that same day. But if you email them early in the morning, I don't think it's unreasonable to hear before they go home. I think that's pretty reasonable. Will they go the extra mile to help you get approved? I think this is less of a big deal than Brian does. Brian actually seems to think that the lender has a huge amount of pull, and I think they do have some pull, but not as big as Brian thinks. I mean, I think a lot of times they're guidelines, and in some cases I could see guidelines being interpreted different ways, and a lender needing to step up and really get an issue pushed through. But I'm not sure it's as big of a deal as Brian makes it out to be, but I could be wrong. You may find it more difficult if you go to big banks versus local banks. I think Brian talked about it in another slide, especially as you have more properties and loans, and don't use the huge online sites either. So I think we already had that. So these are the questions to ask a lender, and they're the basic ones. And so you can go, there's a website address right on there. It's on my website. You can go read through some different ideas. I'm not going to go through these. I'm not going to read them to you because they're really self-explanatory. But maybe I'll make a separate video where I just go through all the questions to ask a lender. But basically, here's one slide on them. And then here's a second slide that covers a bunch of different questions to ask your lender. And these are just from my website in this case, it's about fees and their team. And apparently there's a third one about references. So I got a bunch of different questions on there. Here are some different ones to do. All right, so applying for a loan. Brian jokingly says, embrace the pain. And he may not be that far off because it's pretty intense to get a loan a lot of times. You're going to be asked for the following and probably much more as you go through the process. But you'll need a fully completed loan application. A lot of the lenders nowadays are doing them online, or a personal financial statement, or sometimes both. They'll ask for a color copy of your ID, usually your driver's license. So go ahead and plan on doing that. Go get a scan or a photocopy done if you know you're going to need it. A recent W-2 and any pay stubs you have or any other proof of sources of income. The last 2 years from your tax returns. All bank account, investment account, IRA account statements for the last 3 months. And they do want, for some odd reason, they do want those pages that basically have nothing on them. So if you have a statement that comes in and basically the bank says there's nothing on this page, guess what? They're going to want to see copies of that too. Documentation of where the down payment is coming from. So if you're doing your medical marijuana business and you've got all cash, it's going to be really hard for you to get a loan like that. You're going to need to document exactly where your down payment is coming from and source it. And so talk to your lender way in advance for doing that. Documentation of any large deposits into your account. So, if you just sold a car or, your parents were very generous and they gave you, a really big birthday check, you're going to need to document why those large deposits are coming into your account. If you have other properties, leases, insurance, HOA, mortgage statements for all of the properties that you own, I would just go ahead and keep all those in a folder because you're going to need them at some point. And then any HUD-1 or settlement statements from any recent purchases, especially if they don't appear on your tax return, you're going to want to see those to find out what else you own and what the numbers look like on that as well. All right, some tips for investors when you're applying for a loan. If you know you'll be doing this again, create a process now so it's easy to repeat. I highly suggest creating a folder with all your application documents and updating this information each quarter. So basically, when you're going out there and you're going to be buying properties over time, you're going to nomad it or you're going to buy several investment properties, and you know this is going to be a repeating thing, why not put everything together in one place and keeping it organized? And Dropbox is a great tool for doing that, and then you can simply send the lender a link so they can go download all that stuff. Okay, so we just primarily covered the financing part of the first meeting with James. This is what I would do if I had unlimited amount of time and sit down with a client and kind of go over the different financing options and how stuff works. Now we're going to talk very briefly about the writing offers portion of our first meeting and what you're going to need in order to write an offer. All right, so when we're going to write an offer on a property, By the time we get ready to do an offer, you're going to need to have, at a minimum, a pre-approval letter from your lender. So when you're going to go talk to your lender, the goal is going to be get a pre-approval letter. In theory, ideally, you want to be as far through underwriting as possible. And some lenders will let you go completely through underwriting and have the property be a to-be determined property set up for you. So this makes for a stronger offer. If I can call the seller's agent and say, listen, my buyer is not only pre-approved, we're completely through underwriting. All we need to do is plug in the property. They're like rock solid, ready to go for the loan. They just have a condition on the property itself, and everything else looks amazing. So they're good to go. That's a much stronger thing than saying, my buyer has a pre-qualification letter. They told the lender how much they made and what their expenses and debts were like, and the lender said, yeah, based on that information, you should be good to go. Very different, especially if I can explain it well to the seller's agent that you are like all sorts of qualified, you're completely done through underwriting. Makes a much better case. So before we write an offer, you should have gotten a pre-approval letter that we can include with the offer itself. Don't wait till the last minute. Okay? Before we go look at properties, you should have the lender letter in hand for at least, in theory, you probably should have it for the max you can afford. And that way, if we can't get a hold of your lender and it's late at night and you just saw the perfect property and they need offers by 8 a.m. tomorrow morning, and we're not able to get a hold of your lender to get an updated letter with the lower amount, then we can always say, let's include the one for your max in there. That way they know that you're qualified, and we don't have to worry about the lender letter at 8 a.m. We can make a strong case for your offer. So don't wait till the last minute. We want to have your lender letter early before we go look at houses, ideally. Okay? All right, so getting back to working with real estate agent overview, we covered the first meeting, which we did financing and writing offers. Now let's talk about pre-showings, which is just more of a lot what we covered already. So pre-showings, basically we're talking about qualifying with the lender. Call or one or more lenders get pre-qualified. The ultimate goal of the call is to get a pre-approval letter. You'll want to make a formal application, understand what they'll need and provide it to them as soon as possible. So if they're asking you for the license and copy your license and your taxes and your W-2s and pay stubs, get that over to them as quickly as possible. Get their list and get it over to them. Get rates from them so that you'll know what to plug in when you analyze deals and what your monthly payment will be if you're buying owner-occupant. So say, if I go get a $350,000 loan, what's my monthly payment look like? Know what that is. And know both your comfortable number. If you tell them, listen, I'm probably going to look at a property at about 300, and they tell you, well, you can qualify for 300 easily. Ask them, what is the max I could qualify for, and what would the payment be for that? Because you may, never know, be out there looking at houses, and all of a sudden you see your dream house, and it's a stretch house for you. It's not the house that you want to keep in your budget, but you say, but this is my forever house. This is the house I'm going to live in when I die. And it's $75,000 more than you were hoping to spend. Do you even qualify for that? Better to know up front. And so ask them both your comfortable numbers, the comfortable loan amount you can get for your monthly payment or whatever the monthly payment is for your comfortable purchase price, and then also the max you qualify for. It's not like we're going to use the max, but it's good to have it written down and to know. All right, so we just talked about qualifying with lender. Let's talk about the pre-approval letter. So it's important. You should have this before we look at properties. Get the pre-approval letter from the lender. Have them send it over to me. You can get a copy yourself. When we make the offer, we'll usually ask the lender to adjust it with the exact offer price. Sometimes they'll give me permission. If I've worked with them several times before, some of them will say to me, James, as long as you're below 350 with this client, you can go ahead and adjust the number. I'll give you one in a Word document. Just go ahead and adjust it. But if you would, when you adjust it, just send me over a copy so that I know what went out. I said, sure, no problem. I'll not go above 350. And so if I make an offer for 320, we'll make an offer and show 320. Okay. It's probably about half and half of the basically lenders that will let me adjust their documents. Maybe a little less than half. Okay. Usually it's when people know that I'm not going to mess around with it, right? And then we usually include that letter with DocuSign. Now, some people ask me, why do you go ahead and adjust the lender letter down to be the exact offer price? Why don't you just show their max? If you're buying a $350,000 property, but they can get a $400,000 loan, why don't you want to show strength and show that they qualify for $400,000? Well, one of the reasons I don't want to do that is I don't want them coming back and say, well, they can pay $400,000, they can qualify, and we just came in at $2,000 below asking price, so why not? I know they can afford it. Why don't I just counter back and say they can afford it? If you come in and you say, we can only afford what we're offering, there's an implication there that that's your max, and if it is your max, they may be less inclined to counter. Some people would argue it another way. They'd say that you have strength, but I personally feel that doing it for the offer price is a better way to do it. And then I think I mentioned we'll include your pre-approval letter with the offer when we do it via DocuSign, so that the seller's agent will get a copy of it right away. It's the first thing. In fact, it's on top of our offer. All right, so let's talk about writing the offer. We just talked about the pre-showings. Pre-approval letter. Will you need your pre-approval letter? Use exact price or max you qualify for. I already talked about this. It gets included with your offer, and I talked about that. So it looks like this slide had information I kind of jumped ahead on. Contract to close. Getting approved for the loan. After initial underwriting, you'll receive a list of conditions for loan approval. So a lot of times they'll say, hey, listen, we got your initial documents, your copy of your ID, your W-2s, your taxes, your other property information, but we do need these additional things to verify some stuff or to get clarification before we're willing to approve for your loan. And on the next slide, I'll show you some examples from Brian. The list will be longer if you don't submit everything requested up front, so you might as well just give them as much as you can up front. I would respond very quickly. When they ask you for something, don't say, okay, I can get that to you next Monday. No, you want to jump on this, because it's not like they're going to be turning around as quickly as possible on your stuff, so they're going to need additional time to process it. It also demonstrates to the lender that you are organized on top of your stuff, and they like seeing that. Wouldn't you prefer to work with people who are organized to make your life easier? Brian believes this has caused lenders to go the extra mile for him, and it may be true. So here are some sample loan conditions. I'll kind of just let you read through some of them, but it's an idea of all the different things that they might ask you for, like documentation of tax statements or sign and return documents, like regarding appraisals, like you did this to a property or you didn't do this to a property, or provide information about this deposit that they see in your bank account, or a lease for a unit. And sometimes it's leases for things that aren't even current. I mean, this is some wacky stuff, but just go ahead and smile and send it over to them. I definitely have some clients that this is a very frustrating process for them, but it's part of the process of getting a loan. All right, and then finally, post-closing. So to wrap up here, refinancing tips. So most of the time after you buy a house, you're going to be thinking at some point about doing refinancing. And remember the two types of refinance, rate and term refinance, and then cash out. For a rate and term refinance, take the current loan and change the rate and term as we discussed. Loan to value is typically 80% for one unit, 75% loan to value for duplexes, triplexes, fourplexes. They'll probably require a new appraisal. Some allow you to refi your closing costs and the appraisal costs and buying down the rate to be rolled into the loan. Some don't, by the way. And it's typically used for lowering the interest rate or resetting up your amortization schedule. So there's some different reasons for doing it, but a lot of times if the rates have gone down, it's for lowering the rate. As rates go up, you're really not getting that benefit. Next one is cash out refinance. A new loan includes the old loan plus cash that you're paid at closing. Typically, the loan to value is lower than we're seeing on rate and term. It's usually 75% for one unit or 70% for duplexes, triplexes, and fourplexes. Almost always, you're going to need a new appraisal. Typically used for buy, fix, up, and hold. And the goal is to get all the money you put into the property back to use for the next one. At least that's the goal for some people that are using this for buy, fix, up, and resell. And some lenders will require seasoning of the property. So they may require that you own the property for 6 months, or it's very common for it to be 12 months before they're willing to let you do a cash out refinance. Okay. Stick around for after the class, after the class. So basically, normally when we have live classes, there is a bunch of information that gets passed around and people network and meet some great folks after the investor class. So if you haven't been sticking around, realize that does happen. And so apparently this is a slide to remind you of that. And then finally, there's my contact information. If you would like to reach out and contact me, there's my phone number, my fax number, my email, and my website. And that is a picture of me. I had a client recently comment that, James, that picture is like really old of you. That picture is like 2 years old. There's a lot of agents that they have pictures from when they're in high school and now they're 50. But my picture is 2 years old from late 2014. I think it was October 2014. So it's like 2.5 years old now, but Anyway, there's my picture. This is the end of my presentation. If you've got any questions, go ahead and reach out to me. And I hope to see you at a future investor class. Bye-bye for now.